Welcome back to XRP Update. This is the place where we track the big institutional moves, the backroom handshakes, and the hidden financial shifts before they ever hit the mainstream news. Today's video might completely change how you look at XRP forever. We're not talking about another random moon prediction from Twitter, and we are definitely not looking at some hype-driven chart drawing from TikTok. This is about something far more serious. This is about a detailed institutional thesis backed by macro liquidity models, claiming XRP is gearing up for a staggering 1,064% move toward the $17 level. Now, close your eyes for a second and imagine waking up to see the entire crypto market completely flipped upside down. Imagine XRP overtaking Ethereum for the number 2 spot after years of being doubted, attacked, ridiculed, and completely ignored by the mainstream media. Sounds crazy, right? But here is why smart money is pausing to look at this. While retail traders are losing their minds over daily price candles, some of the world's biggest banking institutions are quietly building infrastructure directly tied to Ripple's tech. So let's ask the real question. Is XRP genuinely setting up for the biggest breakout in crypto history? Or are we all just getting trapped in another overhyped narrative cycle? By the end of this deep dive video, you'll have your answer. Cause without a solid foundation, a $17 target sounds like pure fantasy. Right now, XRP is holding an incredibly critical support zone around $1.40 to $1.50. Now, why does this specific price level matter so much? Think about it. While other altcoins have been bleeding out aggressively during recent market volatility, XRP has shown crazy resilience. It refused to break. This is exactly why macro analysts believe quiet, heavy, institutional accumulation is happening right under our noses. Look at how markets work. If major global banks actually plan to use Ripple for cross-border settlements, they aren't going to wait for the price to explode to $5 or $10 before buying in. That is not how wealth is made. Smart money accumulates during boring, painful, highly skeptical phases, while retail investors panic sell out of sheer boredom. Let's analyze the psychological setup here. When an asset stays flat or holds steady while everything else crashes, it means someone with deep pockets is absorbing all the selling pressure. Every time a retail trader panics and clicks sell at $1.45, a financial institution's algorithm quietly buys it up. They require this exact stability before deploying large-scale capital. If this accumulation theory is correct, then XRP's current consolidation phase is not a sign of weakness at all. It is the ultimate preparation. A launching pad for something significantly larger developing in the background. But this thesis isn't just built on hope or wishful thinking. Analysts are looking closely at market structure and historical data. According to liquidity models, the first major psychological wall XRP needs to absolutely smash is the historical $3 level. Why is $3 the magic number? Because once an asset breaks a historical long-term resistance level with massive trading volume, the entire market psychology shifts instantly. The human brain is wired for FOMO. The very same retail investors who are currently calling XRP a dead coin at $1.40 will suddenly get terrified of missing the boat. They will rush back in, all at once. Media coverage will go into overdrive. YouTube algorithms will pump out emergency videos. Liquidity will flood the order books, and the upward momentum will start feeding itself like a runaway train. But here's the critical difference between this upcoming move and the famous bull run of 2017. Unlike past cycles that were driven by pure retail speculation and hype, this time, the underlying equation has changed. It's about real-world utility. The conversation in institutional boardrooms is no longer about retail traders chasing quick gains. It's about whether global financial systems are actually preparing to integrate blockchain settlement rails into traditional banking operations over the next decade. Let's break down the actual math and economics behind a $17 price tag, because this is where most people get completely confused. Look around you at the global financial landscape. Stablecoins are booming into a multi-billion-dollar asset class. Governments are aggressively testing asset tokenization. And cross-border blockchain settlement is no longer a sci-fi concept. It's a mainstream boardroom discussion. This is where the idea of a trillion-dollar XRP market cap comes into play. Enterprise-level settlement systems, like those used by central banks and global financial institutions, need deep liquidity pools. Why? To avoid something called slippage. If a bank wants to move $500 million from New York to Tokyo instantly, they cannot do it on a thin liquidity rail. Put simply, a low-priced asset with low liquidity cannot efficiently handle global banking volume without causing massive, violent price instability during the transaction itself. Therefore, higher utility and larger transaction volumes naturally and economically demand a higher token valuation. If XRP is meant to settle trillions of dollars of global value, the token price has to be high enough to absorb that volume smoothly. Whether you personally agree with that economic theory or not, it is becoming the #1 topic among institutional crypto researchers right now. Ask yourself this critical question. What happens if Ripple successfully embeds itself into the permanent plumbing of global finance over the next 5 to 10 years? If that scenario plays out, we are no longer talking about just another altcoin competing for retail hype or trading volume against memes. We'll be talking about a core global financial network, something akin to a modernized SWIFT system. This explains the massive mystery, why megacorporations and international banks keep partnering with Ripple, despite years of aggressive regulatory drama in the United States. Think about it. Why would conservative, risk-averse institutions sign agreements with a company wrapped in legal battles? Because they see the long-term roadmap. They know that total regulatory clarity might be the ultimate trigger. The green light that gives traditional banks the confidence to deploy serious institutional capital, without any fear of compliance penalties or future legal problems. When that dam breaks, the entire market narrative surrounding XRP could flip, almost overnight. And we absolutely cannot ignore what is happening right now with institutional investment products. Spot ETFs completely transformed the landscape for Bitcoin and Ethereum. They did something historic. They opened the floodgates for pension funds, hedge funds, corporate treasuries, and legacy asset managers who control trillions of dollars. These entities can now gain direct exposure to crypto without navigating complicated, risky crypto exchanges. Reports are already showing billions of dollars flowing through these institutional pipelines, and XRP is next in line to benefit from this massive structural shift. But remember this, institutional capital behaves completely differently than retail speculation. Large funds don't buy based on Twitter trends. They don't chase overnight hype. They build their positions slowly, over months, evaluating infrastructure, regulatory compliance, and long-term utility potential. Many top-tier analysts believe that because of this slow buying process, the current market still heavily undervalues what Ripple is building globally. They are buying the asset at a discount before the full pipeline opens up. But let's stop right there for a moment, because we need a serious reality check. On this channel, we do not feed you pure hopium. Realism matters if you want to survive in this market. A $17 XRP target means a monstrous market cap expansion. We are talking about a valuation capable of completely reshaping the entire crypto hierarchy. If XRP reaches those levels, it would mean directly challenging Ethereum and pushing close to Bitcoin's dominance. That would represent one of the most historic, violent shifts ever seen in the history of digital assets. While the institutional utility narrative is incredibly strong, critics rightly argue that these numbers are extremely optimistic in the current economic environment. The truth, as it always does, usually lies somewhere in the middle. The technology is real, the banking partnerships are real, but global financial infrastructure takes years to build. Banks move at a snail's pace. Regulatory systems evolve gradually through intense bureaucracy. So while the long-term vision is highly exciting, you, as an investor, need to maintain realistic expectations regarding timing and expect heavy, brutal volatility throughout the process. This is where investor psychology becomes your ultimate superpower, because emotional investing destroys far more portfolios than bad technology ever will. Every single market cycle, the exact same story plays out. Retail investors get trapped chasing viral headlines at the absolute top. Then, when the market inevitably pulls back, corrects, or moves sideways longer than expected, frustration takes over. They lose patience, panic, and exit their positions at the absolute worst possible moment, right before the actual pump begins. Successful investors operate differently. They don't obsess over daily price tickers or emotional price predictions on social media. Instead, they focus on measurable adoption signals. They track transaction growth on the ledger. They look at real tokenization trends. They monitor global payment integrations. And they watch central bank pilot programs. Because ultimately, those are the macro factors that dictate long-term wealth creation. Everything else is just noise. Let's look at the alternative. Traditional finance is under immense pressure right now. The legacy banking system is operating on technology built in the 1970s. It is slow, it is highly expensive, and it is completely outdated for a 24/7 digital world. Modern businesses demand instant payments, cross-border efficiency, and zero friction. This is the exact gap that blockchain technology is filling, and Ripple's core mission has always been solving this specific multi-trillion-dollar problem. Whether critics like it or not, that exact utility narrative continues attracting heavy institutional discussions worldwide. Recent pilot programs involving tokenized real-world assets and cross-chain messaging have only proved one thing. Ripple infrastructure is playing a much larger role inside enterprise finance than anyone originally anticipated. While retail traders panic over short-term price drops, institutional whales are looking at the next 10 years of financial dominance. On-chain data confirms unusual whale wallets absorbing XRP during these boring consolidation phases. They position themselves during times of maximum fear, maximum boredom, and maximum doubt. This brings us to the final key that could unlock the next major phase of exponential growth: global regulatory framework completion. For years, the lack of clear rules created massive hesitation among US-based institutions. Many conservative firms simply avoided direct exposure to avoid any legal risks. But look at the global landscape today. Legislative structures are rapidly evolving across Europe, Asia, and the Middle East. Clear rules are being established. This means we are entering an environment where institutions can finally integrate blockchain assets into their operational systems with 100% confidence. If this happens while Ripple continues expanding its international payment corridors, the market will be forced to reevaluate XRP's role much more aggressively than ever before. Never forget that volatility is a natural feature of this game. Even assets with the strongest fundamentals experience brutal corrections. Anyone telling you that XRP will move in a straight line upward to $17 without major pullbacks is lying to you. Healthy investing requires both optimism and risk awareness simultaneously. That balanced mindset is exactly what separates long-term successful investors from emotional traders who lose everything reacting to short-term noise online. Now, imagine for a moment if this bullish institutional thesis actually plays out over the next few years. Imagine XRP successfully integrating deeper into tokenized finance, global settlement systems, and enterprise liquidity flows. We could potentially witness one of the largest financial transformations in human history, not because of a meme or a hype cycle, but because traditional finance itself is moving on-chain. Whether XRP hits $17 or not, the game has changed. The conversation has evolved into infrastructure, banking integration, and institutional survival. So, I want to ask you directly, if XRP actually pulls this off, hits trillion-dollar territory, and challenges Ethereum for that number 2 spot, would you hold your position long-term because you believe the financial revolution is just getting started? Or would you cash out immediately to secure life-changing profits? I genuinely want to read your perspective. Drop your thoughts in the comments below right now. Let's start a real conversation. If you found real value in today's deep dive, do not forget to smash that like button, subscribe to XRP Update, and turn on all notifications. We will continue bringing you the raw data, the institutional insights, and the real market shifts. before the mainstream media even realizes what's happening. Trust me, the next phase of this story is going to be absolutely massive. Thank you for watching, and I will see you in the very next video. To XRP update and turn on notifications. We'll keep bringing you the real data and institutional insights before the mainstream even realizes what's happening. Trust me, the next phase of this story is going to be massive. See you in the next one.